Most chip stocks have meanwhile been on a tear this year as AI kindles huge demand for more processing power. Even Intel higher, although it lags market leaders NVIDIA and AMD. And the shares are still down 13% in total over the past 52 weeks. But my next guest says the stock may be bottoming. Joining me now is Stacy Rasgon, senior semiconductor analyst at Bernstein. It's great to see you, Stacy. Welcome back.
Good to be here. Thanks.
Intel bottoming. Tell me more.
Yeah, so there's like the tactical and the structural, right? So on the tactical front, I am of the belief that for the first time in a while, numbers like into the back half could potentially be too low rather than too high. It's been a while. We upgraded the stock a couple of months ago on that call, and it's more around PC channel normalization than anything else. They were overshipping demand. Now they're undershipping. That normalizes into the back half and things get a little better. They recently just sort of qualitatively upticked at some of the industry conferences a couple of weeks ago, so that seems to be playing out. I'd also say for Intel, at least in the near term, it gets easier to argue that it's as bad as it can get. Like they've already slashed the dividend. They got people excited that gross margins will be getting back into the 40% range. Like it's unaggressive at that rate. Longer term, they've still got a lot of wood to chop, and you know they did an event yesterday where they were talking about their move to make it more transparent, both internally and externally, what it costs them to actually manufacture their wafers and help them incentivize their own business units to make better choices, because it turns out Intel is not a very efficient manufacturer of parts. And the stock sold off a little bit yesterday. I think people were expecting, they were hoping that they might announce a foundry customer. They didn't announce that. But at the same time, you know, the first thing in all these things is to admit that you have a problem. They finally really admitted that they have a problem. And they put out some numbers around some of the cost savings that are a little more concrete than what they've done. So that was at least somewhat encouraging, I thought.
I mean, the CEO has practically been on an apology tour and really making it clear that he wants to restore this company to the leadership position it once had. Whether he can feasibly do that is another question. And your comment that they didn't announce a foundry partner seems rather significant.
I don't know. I wasn't really expecting them to. They were pretty honest. Like they're what they call PDKs, process development kits, the things that like the foundry partners need in order to design semiconductors that work on their processes. Those PDKs are not mature. They're not baked yet. It's hard for any customers to really sign up until they know that the roadmap and everything is there. So they're not there yet. I wasn't really expecting it. I actually don't think it was hugely expected either, but there was some hope. They actually did say they will be announcing one later in the year. So, I mean, that's still out there, I guess. But like I said, I just thought it was a little refreshing that, you know, Pat's no longer out there pounding the table saying all their problems in the rearview mirror and it's full steam ahead. They're admitting that they've got problems. But at least now they're starting to put a little bit more of a roadmap together on how they're actually going to fix those problems. So, like I said, I'm not an Intel bull, as you probably know, but I found at least that you know, confession and actually putting some numbers behind it, I found that to be at least some, like, mildly refreshing, at least.
I find this almost an apology for even turning slightly more bullish, shall we say. I just was going to ask you at 32, which is where the shares are today, what is that valuation kind of price in? How conservative or not is it?
You know, the stock bottomed around $25 or $26, which is about book value. And so it's a little higher than, I know what it is, 1.2 or 1.3 times book. They still own a fairly sizable Mobileye stake. I think they still own 88% of Mobileye, so you could take that out and it would be like even cheaper. So it's not an aggressive valuation. It's gone lower, and certainly if people like cannot grow convinced over time that their recovery path actually has some legs, I mean, certainly it could go back to where it did. But it bottomed around book value, which was about $25, $26 for them. So it's around 30-ish now, a little higher.
If we're showing the forward PE of 112, I assume they're making more than, you know, a couple cents. I mean, what's going on with earnings?
No, they are not. Like, they're only making a couple of cents.
Wow.
Right? So numbers have probably, from the peak a year and a half, 2 years ago, numbers are probably down 90 or 95%. And frankly, there's some accounting changes in there that they made. Without those accounting changes, they probably would have gone below zero.
Wow.
So the numbers have come down an awful lot. So you can't read too much into the forward 12-month price to forward earnings right now. They're not at a normalized kind of run rate. I mean, the question of what is that normalized run rate is still up for debate. Hopefully it's higher than where they are right now, which actually is, I can't remember where the street is right now, 20 cents or something like that. I can't remember. It's low.
That is low. That is. Stacey,
some of it's cyclical, like it's some of it's internal, some of it's cyclical. The cyclical get better, and then we'll see like what the internal efforts have to bring.